100 to 1. Burn that ratio into your brain. That's the typical number of face-to-face meetings a venture capital firm will have before they invest in one company. How do I know this? I was an entrepreneur in residence at a major venture capital firm in San Francisco, so I saw this ratio play out again, and again. In today's video, I'm going to break down for you the reasons why investors are going to say no to you and what you can do about it. I've raised over $100 million in venture capital and private equity funding, and I've helped entrepreneurs like you raise rounds of between $50,000 and $150 million. I've been around a lot of fundraisings. I know what works and I know what doesn't work. If you're not already a subscriber, then hit that subscribe button right now and you'll get notified every time I release a new video. The reasons why investors won't invest in your startup can be broken up into 3 groups. So let's go through them right now. Group number 1, you're not a fit for the investor you're targeting. Okay, there are 4 reasons why investors aren't going to invest inside of this group. So let's go through them right now. The first one is you're not in a segment the investor is interested in. So let me give you an example of this. Let's say you're a healthcare startup and you target a venture firm or an angel investor group or an angel investor that's interested in software and only invests in software. They're not going to invest in you. You're wasting your time. In fact, they're likely not to even take a meeting with you. The second reason is you're a startup and your startup is not at the stage that the potential investor you're targeting is interested in investing in. So what does this look like? Let's say you're an early stage startup and you target a late stage venture firm. They're not going to invest. Even if they're interested in your space, they're not likely to invest. And again, they're not even likely to take a meeting with you. The third reason is your startup will not move the needle on the potential investor's fund. So let's say the fund has raised $1 billion. And the best case outcome for your startup is maybe $100 million. They're not going to waste their time with you. In fact, again, they're not going to take the meeting because guess what? You're not a fit for them. The fourth one is your company is not in the right geographic space for the potential investor. So what does this one look like? Let me give you an example of this, and I'm going to use a Mark Andreessen quote of Andreessen Horowitz to give you the idea here. Let's go. Where is this startup located? Can it hire the right talent in that location? And will I, as the VC, need to drive more than 20 minutes in my Mercedes McLaren SLR in any direction to get there? The point is geography matters. And it's easier, especially for early stage companies. It's not as bad as it used to be, but it's still better to target investors in your geographic area. So if you're located in Europe and you're trying to get an American investor to invest in your early stage startup, that's going to be really difficult to do. So what's the solution here? Do your homework. That's the solution. It's easy to find the information that you want in today's world. There's no excuse for not researching investors before you reach out to them. If you do your homework, you can cut the list down to investors who are potential investors in your company. That's what you want. So do your homework, do your research, target the right investors, and you'll get better results. Okay, now group number 2 is problems with your startup. So let's go through the reasons here. So there are 3 reasons. Let's go through them. The first one is your company isn't growing quickly enough, even though it's a good company. Let me give you an example of this. Let's say your company is currently at $1 million ARR, a good number. And let's say you believe even with more cash being injected in the company in the next 3 years, here's how you're going to grow. To $1.5 million the next year, $2.2 million the year after that, and let's say the third year is $3.3 million. That's good growth. But it's probably not enough to attract an investment from a leading firm, be it angels or venture capital. That's the problem. The next one is that you have low to no barriers of entry. So what's a company like this? Let's say it's a services company. Like, let's say you're in the dog walking business. That's a pretty crazy example, but it's a great one to explain it, because think about the startup costs of building a dog walking business. It's pretty easy, right? Not much capital is required. And there are very low barriers of entry to get into that business because of the capital requirements. Therefore, it's likely not going to be an exciting business because the moat's small. So therefore, it's probably not going to be an investable business. Now, the third one and final one in this group is, let's call it low switching costs. So what does this look like and what is this described as? Low switching costs is it's easy for me to switch from you to another comparable vendor. So what's a great example of this? Uber is a great example, interestingly enough, where I can go hire out a Lyft, I can go hire out Get if I'm in the right country, I can hire out a taxi. Very easy to switch between those companies. So yes, Uber, fantastically successful company, but the business model, when you really look at it, it's really kind of a broken business model in many different ways. In fact, indeed, that company has never, ever, ever been profitable and probably never will be profitable. I don't recommend that business model, even though it worked for them. So what's the solution here? Well, fix your problems if you can. However, I want to remind you of this. Most startups are not venture fundable or angel fundable. Indeed, 99% of all startups never receive a cent of venture capital or a cent of angel funding. And that's okay. You can still build a great company and a great business without investors. It's fine. And if that's your route, be proud of that route. It's okay. Now, if this content is resonating with you, then hit that like button right now. So let's go to group number 3 on our list. Situations that are unique to the potential investor that you're targeting. And the problem here and the challenge here is you don't know before you meet with the investor. In fact, you may never know that this is a problem. So let me go through some options here in terms of what's going on. The first one is the investor has already invested in a similar business to yours. Typically, most professional investors are loath to invest in similar companies in the same space. So you're not likely to get an investment from them. The second example here, let's say you've targeted the perfect investor. However, the partner in the fund has already made 2 investments in the last 3 months and he or she is out of bandwidth. Can't take on another company. You'll never know it before meeting with them. They take the meeting. They'll always take the meeting because they want to learn. However, it means you're likely not going to get an investment at this time. These are things you never know before you meet with potential investors. So what's the solution? As I said, there's no way of knowing these things before you meet with a potential investor. So what do you do here? It's a numbers game. That means we have to get the numbers working for us. In my particular case, 63 investors passed on us before we raised our initial funding of $12 million. 63. We had to get the numbers to work for us. You need to follow the same route. Maybe it's the first one, maybe it's the second one, maybe it's the 10th one, or maybe you're going to be unlucky like me and it's going to be the 63rd one. You just don't know. You have to target enough potential investors to get over the potential humps inside a venture firm that I've described, or maybe they can't invest even though they want to invest because they've already made the investment, or the partner's too busy, or something else is going on. There are many reasons investors don't invest, and most of them have nothing to do with you. So what did you learn from today's video? What were your insights? I want to know. Put your comments in the comments column below today's video. And if you have questions for me, put them in the comments column below today's video as well, and I'll be happy to answer them for you. Now, I have one more thing for you today. I have a free Startup Pitch Deck template. It has all the slides that you need to put together a great pitch deck when you're pitching investors. All you need to do to get your free Startup Pitch Deck template is click the link below today's video and it's yours for free. Now, to get more great content like today's content from me, all you have to do is just wait about another 20 seconds or so and a couple links are going to pop up, and all you have to do is just click the links. If you want to subscribe to my channel, then hit that subscribe button right now and you'll get notified every time I release a new video. If you like today's video, then hit that like button. And if you want to comment on today's video, then comment on it, please, in the comments column below today's video. My name is Brett at brettjfox.com. I've really enjoyed speaking with you today. Thanks a lot. Take care. Bye.